So welcome back to my channel. So with this strategy, now I will teach you from top to down approach. So in this strategy, you should know about the bias or the order flow. Okay. So to know about the order flow, you should know about the liquidity zones on higher time frame. I'm doing it on daily time frame, but you guys can do it on 4H time frame. Okay. Or you can do it anywhere, like or on 1H time frame, but not on 15-minute. So if I'm doing it on 15 daily time frame, I can see that prices went below of these two relative equal lows, right? And then price made another move, and then it gave a market structure shift from here. You can see this swing high, it gave a market structure shift from here, and then it came down one more time below below of these two relative equal lows. So this is the stop loss zone or liquidity zone. So now when price went down like this over here, I will go on 15-minute time frame or smaller time frame. Okay, so now I know that what is the bias. Okay, bias is bullish because bias was bearish for so many days, but prices went below of the relative equal lows, so it is in too much discount zone. So now from discount zone you should go into a premium zone, right? So now I will go on because the order flow is bullish, so now I will look for buys only on 15-minute time frame. So now if you guys can see over here, I should remove this box. This is a 15-minute chart. Okay, and now on this 15-minute chart, look at over here, we can see these relative equal lows, so many lows right over here, right? And if you see, if there is some retail trader, he will look at as what? Demand zone. Okay, and now over here price came one more time down till this demand zone, and now all the retail traders, they will be looking for buys from here. Right? And their stop loss will be where, like 15 or 20 pips below of this demand zone over here. And so now what is our strategy? Okay, you should look for liquidity rate of the opposite of the trend or bias. So the bias is bullish. Okay, so the bias is going bullish on higher time frame, but on smaller time frame it's going down. And when the bias is bullish, okay, you should look for stop losses, which you should look for sell side liquidity. Okay, in simple terms, so you should look for sell side liquidity if market is bullish. Okay, and if market is bearish, you should look for buy side liquidity. So in this scenario, the market is bullish because on daily time frame prices went below of this demand zone. Okay, so now we all know that it is going below. So now we are looking for the rate of the sell side. So price has gone down and it has taken the sell side right over here. So now we can see it has taken the sell side. And with this strategy, I don't wait for fair value gap, or I can wait for fair value gap entry for more confirmation, but I do it a little bit advanced. So I look for around psychological level like this. Okay, this was around psychological level of 0.64800. So now with our strategy, we know that we are bullish on daily time frame, we are not bullish on 15-minute time frame. As you can see, if somebody will be looking at this move, he will be thinking that it is going to keep on falling down. And over here also, if you guys can see that price gave a breakout and then it gave a retest and then it started to fall. Okay, so now all the retail traders will tap, they will see the breakout, they will take a sell right over here, and they will see this bearish engulfing candle, this one. Okay, and then they will think that okay, market will start falling from here, but it's not. We will do the opposite. In our strategy, we buy below of the demand zone, and if there is a bank level like this, around psychological level, we can just buy it from here. And you can place a stop loss of 20 pips, or in indices 20 points. Okay, or you can do 15 pips stop loss also like this, and it's a big stop loss. Okay, so it will take, if price goes a little bit more deep into a sell side liquidity, then also you will be saved. So now see, in one day only it gave like 1:2.5. But if you would have hold it, and if you would have targeted your daily time frame level, or you would have holded it for 2 days or 3 days, okay, you can see how much profit you would have been made from this strategy. So the thing which I'm trying to say, that you start risking where people will place their stop loss. So in this scenario, in simple words, first you should know the order flow. Okay, you should write it down somewhere. First you should know the order flow. What's the order flow? What do you think that what's the order flow? The order flow is bullish, right? So how you get to know about the order flow? If you look on a higher time frame, you will get to know about the order flow. Okay, the where market is moving overall. And then on second, okay, you should know that where are the stop losses. So how you will know about that, where is the stop losses? Find supply and demands. Okay, find supply and demand, support and resistance in the chart. Okay, and now if you find this supply or demand, so don't take trade. This is the mistake which everybody do. Don't take trade above of the supply zone. Why? Because the order flow is bullish. Okay, and if you take a sell right over here from this round psychological level from here, 0.65400, if you take a sell from here, it will 100% it will go and hit your stop loss. Why? Because the order flow is bullish. Okay, the order flow is bullish, but you want to take a sell from a buy side liquidity, that's not possible. So what I told you before, that when the market order flow, okay, when the market order flow is bullish, okay, then look for the liquidity rate of the opposite of the trend or bias or order flow. So if market is bullish, you should not consider this buy side liquidity, okay, which is right over here. You should consider for the sell side liquidity, which is over here. Okay, so now you can understand. And now how to enter. So you find out liquidity, you find out order flows. Now how to enter. Just place your limits like the institutions do. Okay, they'll just place their limits a little bit below in the liquidity pool or into the stop losses of lots of people. Okay, you can put your limit right over here and you can take a stop loss of 15 pips or 20 pips. Okay, and after that you should do your money management or risk management on the basis of your capital, and then you can take the trade. So it's a 3-step or 4-step process. Okay, it's easy and it's totally based on liquidity. Okay, I'm not looking for any fair value gap, I'm not looking for any order block, I'm not looking for what you call it, breaker pattern, which you can do. If you want more confirmation, you can look for that. Like over here you can see that there was a fair value gap right over here. You could have got entry right over here. Okay, but I don't do that because in that thing the strike rate of hitting take profit is very low. Okay, because sometimes what will happen is that you can see this fair value gap, but if you take an entry right over here and if you put your stop loss just below this, price will go down one more time and it will take your stop loss and then it will go up. So don't do that. Okay, so or if you want, you can do it on a fair value gap. It's your choice. Okay, and the thing is that it's only based on liquidity. Okay, it's not based on fair value gap, order block, or optimal trade entry, which you can use. But the thing is that if you only look for liquidity in the market, that makes it easier. If you're only looking for liquidity in the market, you can easily take trades. Okay, and it will be easy for you because see, I can see lots of people like what they do is like, I know that ICT also uses some fancy names, right? Like fancy names, like this is so complex that you should use fancy names. That's not a bad thing, but for a beginner or like for a guy who is learning right now, if he sees so many fancy terms like order block, fair value gap, reversion fair value gap, refined fair value gap, or something, like if they hear about all of this, right, they will be overwhelmed and they will be not able to trade and they will do opposite of it. Okay, so that's why the thing which I'm trying to say is that you should keep it simple. So this is the only way to keep it simple. Okay, just look for the stop losses, just look for the stop losses and just look for the liquidity, because the liquidity is the main thing. The whole 80% of the game is done by liquidity, 80 to 90%. Okay, because liquidity is important, then only your fair value gaps and order blocks will work. If there is no liquidity taken or no liquidity grab, your trade will not work, your fair value gap will not work, your order block will not work. Okay, so I hope you guys understood what I tried to say. So, and this is a very easy process, and if you guys have any questions or any doubt, you can ask me in the comment sections, or you can DM me on Discord or Instagram, and if I have a time I will just give you answers of your questions. So and please like, share it, and subscribe and turn on the post notifications, because I post every day. And so until next time, wish you good luck and be safe.